And it sounds to me that one of the misunderstandings people have is there is no black box. It doesn't really happen that way because the element of questions, and sure, some other may be more advanced in creating AI questioning. Sure, I'm sure people are working on it, but there doesn't sound that there is a black box that comes up with magic answers and he who develops the best black box wins. It's a much more nuanced process than that.
I agree with that. And the concept of black box is kind of this amorphous term that's been thrown around for models and systems that we really can't explain that well. And there's an element of that in AI. There's an element of that in machine learning. But really, in any investment process, we're asking a question, which is, if we do something, does the market, or do we deserve to get paid for it? So really understanding what we deserve to get paid for, what value we're bringing to them.
What does that mean, deserve to get paid for?
So think about back in the early days of block trading. There are some very well-known investors who made a lot of money setting up both hedge funds that effectively did block trading, as well as desks that did block trading on the sell side. Block traders are effectively providing liquidity at a time of need to institutional investors or large investors. And they deserve to get compensated for the risk they're taking of making a large purchase or sale at a given period of time. And effectively, they're creating somewhat of an insurance product for an investor who wants to get out of a position. And they should get a return for that service that they provide. They're taking some risk, they get some return for taking that risk. For a factor investor, let's say a value investor, there's a different service that a value investor provides to the market. A value investor is typically buying stocks that are low multiple stocks. And if they're building a long short portfolio, a market neutral value investor, they're selling short stocks that have high multiples, right? So they're effectively doing two things. Number one, they're providing capital to companies that have low multiples that have likely seen their multiples decline, right? So in a way, they're writing a put on low multiple companies, right? And for writing that put, they should get some decay, some carry on that. They're also selling short companies that have high multiples, right? Betting that those high multiple companies either remain the same or go down in value, and they're effectively writing a call option on that aspect of the portfolio. So they should get paid that decay in both wings, right? And they should make money if there is mean reversion between those. You see multiple expansion on the ones you bought, multiple contractions on the one you sold. You should make money in the middle for taking that risk in the belly. And every single strategy likely has a rationale for being paid. And understanding that's very important. So for an investor, like these black box strategies, right, there are aspects that you don't know, but there are also some features of the strategy that effectively you should be paid for. You're taking some risk that you should be rewarded for.